Jai Hind to all, and welcome to this first session of Financial Management and Corporate Finance. This is related to unit number 1, and in the first lecture, I will give you the introduction of financial management. Now, what is finance? Finance is very familiar word. We all think about finance when we discuss anything, discuss about the budget of the home or the country or about any company. We generally read something about the finance. But in the corporate world, finance include lots of activities like investing, borrowing, lending, budgeting, saving, and forecasting. It is not related to only money matters. It is related to lending, how to borrow, how to lend, how to make budgets, how to forecast, how to make planning, how to make strategy related to finance. There are three main types of finance. First is personal, second is corporate, and third one is public or government. Personal finance is like when we go for home loan, then we approach a bank and we know we need a home loan for buying a home. So that is our first personal need, and this type of finance is personal finance. It is very much similar to the you can say car loan or education loan or any loan for the personal need. In case of corporate finance, the finance and all related activities are related to company, a business organization. It can be small business, it can be large business, or anything. In case of government or public, it is related to the finance matters of a government. It can be central, it can be state government, or any public company. Normally, finance is the provision of money at the time when it is required. Yes, this is the standard definition. When we need money, we need finance. And all the activities are related or associated with the finance. Now, here we have the business organization. When we think about corporate finance, then it can be related to sole proprietor, it can be related to partnership firm, it can be company, or it can be limited company, private limited company, or a trust if it is the trust is doing some business. So, business finance is a process of raising funds, providing and all administration related activities of all money and fund which is used for a business enterprise. When we think about corporate finance, then we generally not discuss the personal need, personal finance. We dedicately, exclusively, we think about the financial need of a business organization. The scope of the corporate finance covers the financial activities of the business enterprise right from the inception. Then when your company, when your business start till the growth, the expansion, the wind up, all these, that means all the phases of the business will be covered under the corporate finance. In the simple word, financial management as practiced by corporate business firms are called corporation or business finance. It can be related to raising of the fund, that from where the fund will come, who are the investors, from where the money fund will be arranged, how it will be invested, how it will be utilized, and how it will be distributed. Now, what are the finance functions? What are the purposes of the finance function first? The purpose, objective, motives of the finance function is to acquire sufficient fund. Sufficient means it is not overfunding or not underfunding. That means the fund which is actually required by the company at any point of time will be under the finance function. Then proper utilization of fund means once the funds are arranged from any source, selection of source itself is a you can say it is a decision taken under finance function. Then it comes proper utilization. Raising a fund is important. Yes, it costs, it have efforts, it needs efforts. But if you're not utilizing the funds properly, then it will be of no use. Raising funds is important more than that of proper utilization. If proper utilization of fund is not made, then no revenue will be generated or profit generated by the company will be lower or it can be lost, right? Increasing profitability. Yes, the finance function The motive of the finance function is to increase the profitability of the company because it is directly related to sustainability. Profitability is necessary for every organization. Yes, they are not doing any charity. Profit is the base for long-term sustainability. The company must be in profit. Otherwise, it is very difficult for the company to run for a long time. The planning and the control function of the finance aims at increasing profitability of the firm. Then maximizing concern value. Concern means firm or business organization. It can be company or anything. So the value means the value of the overall business. That means which is related to wealth. That means the purpose of the company, purpose of the finance function is to increase the profitability, that is profit maximization, and wealth maximization too. That means the value of the company must be increased, and the final motive of the ultimate finance function is to get the maximum value for its shareholder. So these are the functions, these are the motives, these are the aims of the finance function. Why we need finance function in a business, in a company. Then what are the scope of the finance function? Some of the major functions of the financial manager are, or what are the scope? What different types of decisions which are taken by a finance manager? It is estimating the amount of capital required. This is the first, you can say, step. When you start a business, obviously you make a budget, you make a estimation that for how much fund, how much capital is required for the business. Selection of source, arrangement of the fund is the second step. First, you must know that what is the actual requirement. Then determine the capital structure. Then you have to decide that whether this capital is collected, is arranged by own fund, or you want to use borrowed fund, borrowed sources. That is your choice. The decisions are taken on the different analysis of the capital structure. There are so many techniques which are helping you to decide that what the capital structure should be, what is the optimum capital structure. This will be discussed later on in the different units. We have the techniques, right? We will discuss this later on. Choice of the sources of fund. Choice of the sources means that can be own fund, that can be borrowed fund. Under own fund, there are choices, right? It can be equity, or it can be your own savings, your retained earning, or it can be borrowed fund. Then you have the choices that it can be debenture, it can be bond, it can be long-term loans arranged from the financial institution, etc. So that is a you can say the function, the basic scope of the finance function, where the finance manager has to decide that which source is the best one. Then procurement of the fund. Procurement of the fund means once you selected the source, then how to procure it. Obviously, the cost of funds should be minimum in case of the procurement. That the best decision of the procurement is to get the cheapest fund at the you can say the process must be easy. There should be no hurdle within time limit. Must be cheap, but at the same time the hurdle should not be there. Then utilization of the funds, how to utilize. This is again the type of decision taken by the finance manager. It is within the scope of the finance function that how to utilize the fund. From where you get it, that from step number 1 to 4, you have to arrange that from where you will get the funds. But at point number 5, you have to decide that what is the best utilization of the fund. Obviously, the company will generate profit if the utilization of the fund is optimal. Then disposal of profit or surplus. Yes, if the profit is there, then how to dispose it. Whether you want to distribute it as a dividend or you want to retain in the company. Again, lots of analysis is required in this decision too. Management of cash. For the liquidity management, for the short-term liquidity, management of the cash should be very strong. So it is again scope, you can say it's a part of finance function, subset of the finance function. Then it comes financial control. Obviously, control is required. If it is not controlled, then you can say you are not able to achieve your objective, and your activities will be distracted, and the final result can be against the basic objective of the company. Now we have few definitions related to finance management. Finance management is an activity concerned with planning, raising, controlling, and administrating the funds used in the business. Right? One more definition we have. Financial management is the area is that area of business management devoted to a judicious use of capital and careful selection of the source of capital in order to enable a spending unit to move in the direction of reaching the goal. So, all these, when you study carefully, all these definitions are giving the same thing, that how to use the fund wisely in the business, judiciously in the business. That means the optimum utilization, optimum selection. And what optimum? Optimum means towards the profit maximization and wealth maximization goal of the business. Now, there are few functions which we have already discussed in the previous slide, but here something details are given, that what are the functions of the finance management, what type of decisions, what are the function of finance manager basically. So as I have already told you, that estimation of the required capital, obviously the finance manager is the person who is responsible to calculate the required capital. Required capital, if suppose if you are starting a new business, new company, then your requirement will be different. But if you are running business, running company, then you want expansion plan, or you want to set up new office, or you want to start a new production line, then your requirement will be different. Then finance manager has to see that what is the requirement, why the funds are required, and what is the actual requirement. That means the fund is required for, suppose if you want to start a new office, then fund is required for, suppose, purchasing of the office or leasing of the office, then funds are required for fixed assets, right? Then in nutshell, manager has to make a proper estimation in form of budget. That will be a very good idea. If you prepare a capital requirement budget, then it will be very easy for a manager to make the further plans, right? So this is the you can say fundamental stone, fundamental step for a good finance function, right? Then you have to decide capital structure. Once you decide that how much capital is required, then you have to check that what can be the sources, kahan se arrange karna hai, what can be the sources. It can be a bank loan, it can be equity share capital, it can be a unsecured loan arranged from a friend or family relatives, or it can be a long term loan or short term loan. That decision will be taken on the basis of different principle, different finance principles are there. So you have to decide, you must decide, basically you must decide on the basis of different finance principles, which are basically guiding principle, to decide that what is the requirement and what is the source. Then matching must be there, your requirement must be matched with the source. If the long term requirement is there in the business, then your capital structure must be long term. I mean, the requirement must be fulfilled from the long-term sources or vice versa. Now, next step is evaluate and select sources of funds. Once you decided that your requirement is long-term need, right? Long-term requirement is there in the business, and then you selected that what are different long-term sources available to you. Then you have to evaluate each and every sources, and then you have to select that which source is better. What will be the deciding factor? Deciding factor may be the lowest cost of capital, lowest rate of interest, right? If you are using loans, and even the time and processing. That processing must not be too long, right? Yes, if it is a, you can say it is a cheaper loan, cheaper in the market, so many companies are available who are ready to give you loans, and the rate of interest may be low. But if there is any problem in the processing, they are taking too much time in the processing, then it will be very difficult for you, because you have a time limit to decide the capital requirement, to get the funds as soon as possible, right? So these when you want to decide the source, then you have to check all these factors which are related to selection. Allocate and control fund, yes, allocation. Once you get your fund, then it will be allocated to the different financial activities, right, for which you arrange the fund. Then distribute the profit. or surplus. Once your business is going on properly, you are generating profit, then the finance manager has to decide that what to do with the profits, whether it is distributed to the shareholders, to the investors, or it will be retained within the business for future use. Then monitoring financial activity is also the function of the finance manager, right? You have to monitor, you have to control all the financial activity, and you have to check that all the activities are moving in the same direction, which is going towards the objective of the business or objective of the financial management, right? All the non-value added activity must be eliminated to get your objectives. So these are the uh, some steps, you can say. These are some concept that how the decisions are taken, what type of different decisions are taken by a manager, by a company, right? So three major category, you can say three major categories of the decisions are taken by any company if they want to fulfill their dreams, if they want to achieve their target. These decisions are investment decisions. Investment decisions means the investment decision is related to the acquisition of the assets, right? How to acquire an asset. Invest in the asset that earn a return greater than the minimum acceptable hurdle rate. Obviously, when you start a business, you have something in your mind, that is your expectation. Why you start a business? You want to earn profit. You want to earn profit, then what should be the minimum rate of return you wanted from the investment, right? So, this is known as hurdle rate of return. So, investment decisions are like decisions related to acquisition of the company, related to acquisition of the assets, and then you have to decide that in case of acquisition of assets, purchasing of the asset, you have to see that the return generated by the asset must be comparable with the hurdle rate. That means it must satisfy your minimum expectation, right? So you have to see it. Then financial decision. Financial decision means find the right kind of debt for your company and right mix of debt and equity to fund your operation. Obviously, as I have already told you, that two types of sources are available. First is borrowed fund, second is owned fund. So if you want to use both of the sources, that means you have a good combination of debt and equity in your business, right? We generally think that that is not good for the company, right? Because it will create lots of risk for the company. But there are certain situations when company can make lots of profit, the good direction, if they are using debt in the company. We see that the company is levered one, leverage company. Okay, levered company means the company having debt in their capital structure. So for the maximization of the wealth, maximization of the value of the company, generally debt equity, a good debt equity mix will be helpful for the company. The right kind of the debt matches with the you can say tenure of the asset. It is very much related to the matching principle, as I have already told you, that the need must be matched with the sources. For long-term need, long-term sources must be used. For short-term need, short-term finance sources must be used. Third type of decision taken by the managers are related to dividend decision. If you cannot find investment that makes your minimum acceptable rate, return the cash to the owners for your business, owners of your business. So if you are not earning profits in your business, then obviously you have to return the amount, the profit to the investors so that they can use it wisely. Or on the other side, if you have better options, then you can retain the profit and reinvest in the business, and then make more and more profit that will satisfy the investors need. So these decisions are taken under dividend decision. Now, what is the difference between profit maximization and wealth maximization? These two, both of them, profit maximization as well as wealth maximization, are the objectives of the company. As where we can say that no company is there in the market for the charity. Obviously, they are for the profit making, but there is a concept in the modern thinking, or you can say in the modern era, that wealth maximization is also there. Profit maximization is not only target. This is a short term target, and it should not be the only target for the company. Company should think for the with the long term vision, and wealth maximization will give you lots of you can say value addition if you are including this wealth maximization in your goal. So what are the basic difference? Profit maximization is basically a single period or short-term goal. For 1 year, for 2 year, you can think for the profit. But if you want to remain in the industry for a long term, then you have to think about the wealth maximization of the shareholder. You have to satisfy your shareholders, right? And you have to make it long-term goal. Okay. It is usually interpreted to mean the maximization of profit within a given time period. The firm may maximize its short-term profit at the expenses of its long-term profitability and still realize this goal. In contrast, shareholder wealth maximization is a long-term goal. Shareholders are interested in future as well as present profit. Obviously, if you are not, suppose you are a company and you're not giving dividend for 1 or 2 year or 3 year, your investors will be satisfied. If they are thinking that the long-term goals of the company is very good, there is a, you can say, there is a prospect, there is a hope of long-term development, long-term progress, then obviously your investors will be with you. They will invest in your company and have patience. Okay, they will wait. Wealth maximization is generally preferred because it considers wealth for the long term, risk or uncertainty. Obviously, when you are thinking, when you are taking a decision for the long term, then risk item, risk, you can say the portion of the risk is always there, and you have to think it about the timings of the return and the shareholders return. That's why if we have a question that which one is better, profit maximization or wealth maximization, then after lots of discussion, lots of theories, there are a school of thoughts, then at the end of the day we think that profit maximization is a short term goal and wealth maximization is better than profit maximization. These are few financial decisions. We have already discussed it. There's no need to read it again. Okay. Now, this is the financial system. This financial system is everywhere. In every country, there is a financial system. There are a few differences. The infrastructure on the, you can say, the minor level, but on the broader level, all the financial systems are same in every country. In the financial system of any country, there are financial institutions. Financial institution means like bankers, like insurance companies, mutual fund, provident fund, NBFC, non-banking financial corporations, or long-term funds provider, stock markets, right? Uh, your stock exchange. All these institutions combinedly make a financial system. Financial system will help you to create, to know the suppliers, who are the suppliers, right? These financial institutions are basically make a bridge between suppliers and demanders, right? There are few suppliers of the fund, they have surplus fund and they want to give it to the person, to the companies who are in need, right? So suppliers of the fund will approach to the banker, and obviously banker will act as a link between the borrower and the supplier. Supplier of the fund can be individual. Yes, when you go to the bank, you deposit your amount as a FD. Yes, you will be a supplier. And the amount which are received as deposit from the public, the bank will lend it to the companies, to the different business person as loan. Okay, and these loans are the assets. These loans are assets of the bankers, assets of the banking companies. So suppliers can be individual, businesses, governments, and obviously these two are demanders also. Government also need funds, businessmen also need fund, individual needs fund. Individual, in case of individual, we say personal finance. In case of business, we say corporate finance, and in case of government, we can say public finance. Okay. Financial market are also part of financial institution, financial system of the country. Financial market can be money market or capital market depending upon the instrument in which they are trading. That's all in this unit. In next unit, I will give you some insight related to corporate finance. Thank you so much.